everyone, this is Nalini ND, Assistant Professor, Department of Commerce, GFGC, Madhugiri, Tumkur District. Now I am going to discuss about working capital management, which is 5th unit in AFM subject, Advanced Financial Management subject, 6th semester, BCom, CBCS, Tumkur University, Tumkur. So generally, first let us discuss the capital is required for business can be categorized into two. One is fixed capital, another one is working capital. So every business needs funds for two purposes: for its establishment and to carry out its day-to-day operation. Long-term funds are required to create the production facilities through the purchase of fixed assets such as plant and machinery, land and building. Then comes the working capital. So working capital is required to meet the day-to-day operations of the business. Coming to the definitions, in the words of Shubin, working capital is the amount of funds necessary to cover the cost of operating the enterprise. According to Jenistenberg, circulating capital means current assets of a company that are changed in the ordinary course of business from one form to another, as for example from cash to inventories. So inventories we mean raw materials, work in progress, stores and spares and finished goods. Then inventories to receivables and receivables into cash. Classification or kinds of working capital. First one, gross working capital. The gross working capital is the capital invested in total current assets of the enterprise. So gross working capital is equal to total current assets. So what do you mean by current assets? Current assets are the assets which are converted into cash within a short period, say 12 months. So then comes the components of current assets. The components of current assets includes cash in hand, cash at bank, debtors, bills receivables, prepaid expenses, stock or inventory, which includes raw materials, work in progress, stores and spares, finished goods. Second type of working capital is net working capital. Net working capital is the excess of current assets over current liabilities. Net working capital equals current assets minus current liabilities. So here we have understood what you mean by current assets. Next we'll understand what is current liabilities. Current liabilities means liabilities to be discharged or disposed of within a period of 1 year. So then comes the components of current liabilities: bills payable, sundry creditors, accrued or outstanding expenses, short-term loans, dividends payable, bank overdraft, provision for taxation if it does not amount to appropriation of profit. These are current liabilities. So net working capital is equal to current assets minus current liabilities. Net working capital may be positive or negative. When the current assets exceed current liabilities, the working capital is positive. When current liabilities are more than the current assets, then it is said to be negative. Permanent working capital. Permanent or fixed working capital is the minimum amount which is required to ensure effective utilization of fixed facilities and for maintaining the circulation of current assets. There is also always a minimum level of current assets which is continuously required by the enterprises to carry out its normal business operations. So for example, every firm has to maintain a minimum level of raw materials or work in progress or finished goods and cash balances. This minimum level of current assets is called permanent or fixed working capital, as this part of capital is permanently blocked in current assets. Next and the last one you have is temporary or variable working capital. Temporary or variable working capital is the amount of working capital which is required to meet seasonal demand and some special exigencies. Exigencies here we mean urgent need dealt without any delay. This temporary working capital is differ from this permanent working capital in the sense that it is required for short period and cannot be permanently employed gainfully in the business. So working capital is lifeblood and also now center of any business. Just as the circulation of blood is essential in the human body for maintaining life, the working capital is very much essential to maintain the smooth running and functioning of the business. No business can successfully run without adequate working capital. The main advantages or importance of adequate working capital are: first one, it is going to help in maintaining the solvency of the business by providing uninterrupted flow of production. So then it enables a business concern to make prompt payment and helps in creating and maintaining goodwill. Thirdly, you have high solvency and credit rate standing can arrange loans from banks and on others on easy and favorable terms. A company which has ample working capital can make a regular payment of wages and salaries. And the next one you have is the concerns with adequate working capital can exploit the favorable market conditions such as purchasing its requirements in bulk when the prices are lower and by holding its inventories for higher prices. Next one you have is adequacy of working capital creates an environment of security, confidence and high morale and creates overall efficiency in the organization. There should be adequate working capital in every organization. If the capital is more or excessive, it may lead to some disadvantages or there may be some dangers of this excessive working capital. So, in that first one you have is excessive working capital implies excessive debtors and it shows the defective credit policy which may cause higher incidence of bad debts. And then you have redundant working capital gives rise to some speculative transaction. So we may or a company may indulge in some speculative transactions. And thirdly, you have excessive working capital means idle funds. So that means to say that it is not going to earn profits for the business. So you're not going to get a return on investment. Then if you have more and more or excessive working capital, so unnecessary purchasing and accumulation of inventories, so which is going to cause more chances of theft, waste and losses. So it may result in overall inefficiency in the organization. Dangers of inadequate working capital. So if you have more working capital, then also it will be a problem for an organization. At the same time, if you have inadequate working capital, it is also danger to any organization, because first thing, you cannot pay its short-term liabilities in time. So when it is not able to pay its short-term liabilities in time, it will lose its reputation and may not be able to get credit facilities in future. And the second thing you have is it cannot buy its requirements in bulk and cannot avail discount. So if you buy in bulk, you are going to get discounts. Suppose if you don't have that much of working capital, we are not going to get that benefit. Next one you have is efficient utilization of fixed assets. It becomes impossible. Then you have difficult for the firm to exploit favorable market condition. Suppose if there is any demand for product, then it won't be able to exploit that market condition because of this inadequate working capital. The firm cannot pay the day-to-day expenses of its operation and it creates inefficiencies and it increases the cost and it reduces the profits of the business. Second one you have is size of business or scale of operations. The working capital requirements of a concern are directly influenced by the size of its business, which may be measured in terms of scale of operations. Greater the size of the business unit, generally larger will be the requirement of working capital. But however, in some cases, even a smaller concern may need more working capital due to high overhead charges, inefficient use of available resources, and other economic disadvantages of small size. Then third point you have is production policy. See, in some certain industries, the demand is subject to wide fluctuation due to seasonal variation. So the production could be kept either steady by accumulating inventories during the slack periods with a view to meet high demand during the peak season, or the production could be curtailed or cut down during the slack season and increased during the peak season. If the policy is to keep production steady by accumulating inventories, it requires higher working capital. The next one you have is manufacturing process or length of the production cycle. In manufacturing business, the requirements of working capital increases in direct proportion to the length of manufacturing process. Longer the process period of manufacture, larger the amount of working capital required. The longer the manufacturing time, the raw materials and other supplies have to be carried for longer period in process with a progressive increment of labor and service cost before the finished goods is finally obtained. So longer the manufacturing process, higher will be the working capital or more will be the working capital. Shorter the manufacturing process, smaller will be the amount of working capital needed. Next comes the seasonal variations. So in certain industries, raw materials is not available throughout the year. So they have to buy raw materials in bulk during the season to ensure uninterrupted flow and process them during the entire year. A huge amount is thus blocked in the form of material inventories during such seasons, which give rise to more working capital requirement. Generally, during the busy season, the firm requires larger working capital than the slack season. So, generally in busy seasons, we need more working capital, and during slack season, you need less working capital. Then comes the working capital cycle. In a manufacturing concern, the working capital cycle starts with purchase of raw materials and ends up with realization of cash from the sale of finished goods. This cycle involves purchase of raw materials and stores its conversion into finished goods through the work in progress with the progressive increment of labor and service cost, and conversion of finished goods into sales, debtors and receivables, and ultimately realization of cash. And this cycle continues again from cash to purchase of raw materials and so on. So in a nutshell, we can say that the speed with which the working capital completes one cycle determines the requirement of capital. Longer the period of cycle, larger is the working capital requirements. Next comes the credit policy. A concern that purchases its requirements on credit and sells its products or services on cash. It requires less amount of working capital. On the other hand, a concern buying its requirement for cash and allowing credit to its customer shall need larger amount of working capital, as a very huge amount of funds are bound to be tied up in debtors or bills receivables. Then comes the dividend policy. So the dividend policy of a company or a concern also influences the requirement of its working capital. A firm that maintains a steady high rate of cash dividend irrespective of generation of profits need more working capital than the firm that retains larger amount of its profits and does not pay so high rate of cash dividend. That means if your dividend payout ratio is more, then you need to maintain more working capital, and the dividend payout ratio is less, then you need not maintain a more working capital. Next comes the stock turnover, that is rate of stock turnover. So here there is a high degree of inverse relationship between the quantum of working capital and the velocity that is the speed with which the sales are effected. A firm having a high rate of stock turnover will need lower amount of working capital as compared to the firm having low rate of turnover. For example, in case of a precious stone dealer or any jewelers, the turnover is very slow. They have to maintain large variety of stock and the movement of stock is very low. Thus, the working capital of a such dealer shall be higher than that of a provision store where the turnover is very fast. Then comes the business cycles. So here business cycles refers to alternative expansion and contraction in general business activity. In the period of boom, when the business is prosperous, there is a need for larger amount of working capital due to increase in sales, rise in prices, optimistic expansion of business and etc. On the contrary, in the times of depression, where there is a downswing of the cycle, the business contracts, sales decline, difficulties are faced, and collections from debtors, and firms may have to have a large amount of working capital lying idle. So, here we can say that in the boom period, we need more working capital, and in the depression period, the large amount of working capital is lying idle. Approaches to estimation of working capital requirements. First one you have is total approach. Under this approach, all costs including depreciation and profit margin are included. Production overhead inclusive of depreciation is considered for the calculation of work in progress. In the same manner, cost of goods produced includes depreciation. Computation of funds invested in debtors is done on the basis of selling price including profit margin. So in short, we can say that depreciation must be included in calculation of cost of work in progress and cost of goods produced, and profit margin is included in calculation of or computation of funds invested in debtors. The second approach you have is cash cost approach. Under this approach, the amount of working capital is estimated on the basis of cash cost incurred. Here, depreciation being a non-cash item is excluded while calculating the cost of work in progress and cost of good produced and cost of goods sold. So, at the same manner, debtors are computed on the basis of cash cost of sales excluding profit margin. So here in short we can say that in cash cost approach we have to exclude depreciation because it is a non-cash item, and the debtors, in calculation of debtors we have to exclude the profit margin. Methods of estimating working capital requirements. So you have 5 methods of estimating working capital requirements. So first one you have is percentage of sales method, second one is regression analysis method, third one for cash forecasting method, fourth operating cycle method, and fifth projected balance sheet method. So for our Tumkur University syllabus we have only problems on operating cycle method and projected balance sheet method, that is current assets and current liabilities method. Thank you.